Hey folks, it's Liquid here. Welcome back to another SPY weekly update where I try to beat the market by using options. This is looking at a daily chart of the SPY, and as you can see, this week has been pretty bullish. It is now Friday and the market has closed, so we're going to take a look at my options throughout this week and how they performed. I think this is the first week where all 5 trading days I have been positive. So on Monday, it was pretty much just going up and down and chopping, and I was able to make $205 by selling some calls. On Tuesday, made about the same amount of money again, selling puts and calls, sort of using a short strangle strategy. On Wednesday, I had quite a few trades. In the morning, I was bearish, and in the afternoon, I was bullish. So bear calls in the morning, and here you can see bull puts in the afternoon. If I go to the 5-minute chart, we can see on Wednesday, bearish because the 9 and 21 EMAs are going down. This is a 5-minute chart. And then at 2 p.m. was the interest rate announcement, and Jay Powell started to talk at 2:30, so that's what all this volatility was. Usually there's a really big move when there's an interest rate announcement, when the FOMC does a press conference. Sometimes that happens during the day, like it would be on a Wednesday, but sometimes it happens a day after or even a couple of days after. So if you go back to previous FOMC meetings, you'll see that by the next day, there's usually a really large move in the stock market, and it's typically down, although sometimes it could move up. And this time we didn't see a lot of movement on Wednesday. There was a lot of volatility after the announcement, but it was mainly just chop because it went up and then down. There wasn't a single directional move, which meant the big move was probably coming on Thursday. And that's what happened. On Thursday, the market gapped up in the morning and there was a huge sell-off in the afternoon. And luckily, I was able to take advantage of that movement, and I made $2,100 on Thursday just from options, and it was mainly this 458 straddle right here. So I'm going to talk about this and then go over my trades for today, which is Friday. But yesterday, July 27th, that's what we're looking at right now on this screen. At 9:16, I decided to put in some straddles at a strike price of 458. So a straddle is when I buy a call and buy a put at the same time for the same strike. So in this case, the strike is 458, and I basically bought a 458 call and a 458 put, which means I had to pay, as you can see here, $117 for each pair of straddle. Now, the way a straddle works is I make a lot of money if the stock goes in either direction, but if the stock stays put, basically at the strike price, then I lose all of my premiums that I paid. So taking a look at the stock market on Thursday, this is what I was thinking when I put in the straddle around here, 12:20, which is around 9:20 Pacific time. I noticed that there was a gap up in the morning from the previous day, from Wednesday's close, and the market started to go down. Usually what happens when there's a gap is there's 2 scenarios. You either have a gap and go, where the market gaps up and it just continues going higher. That did not happen this time, so most likely it's going to be the other scenario, which is a gap and fill, which means you have this gap up and then the market goes down and fills this gap. It doesn't necessarily have to close the day below where the market closed the day before, but it's very likely, especially when it's going down like this, that it's going to fill this gap sometime during the day. And if it does that, then I want to take advantage of that. So at this time, around 12:30, you can see the market's been going down, but then the green EMA, the 9 EMA, which is a shorter time frame than the 21, it's bouncing off the 21 and it's starting to head up. So at this point, it kind of tells me there's a really high chance that one of 2 things will happen. Either the market from here, because remember at this time I did not know what the market was going to do, but I had a pretty good feeling that either it's going to come up, test the highs of the day, and then continue going down to fill this gap, in which case the market would drop lower, or it's going to continue going up, go past this point, and then go on higher and probably finish the day somewhere around 460. Because that is the top of this bull channel that the market has been in for the last month or so. So there was a chance that it was either going to go up to about 460, 461, or it was going to fill this and go back down to 455.5. In either case, if I buy a straddle at 458 at that time for $117, I would make money no matter which direction the market goes, as long as I'm able to get out before the end of the day and close my position. The only risk to this straddle is if the market just kind of hovers in here and kind of just chops back and forth like this, then I would not make any money. But the chances of that are pretty small, so I was quite comfortable putting on that straddle. And about half an hour after I put in that trade, you can see the market started to fall quite aggressively. Now, my target was over here at 455.5, which is the close from the previous day, and that would mean that the gap is filled. So when the market dropped below that, and as you can see over here, this is around 3 o'clock, it bounced back up. And for the first time since it started falling, on the 5-minute chart, the SPY closed a 5-minute candle above the green line, above the 9 EMA. So at this point, I didn't know if this was the bottom for the day, but I wanted to scale out just in case it was. So this was around 3 o'clock, 3:10, and you can see here at 12:13, so this would be like 3:13, I sold one of the puts for my straddle at 482. And the reason I didn't close the straddle is because if I close the straddle, I would have to close 2 options. But if I just close the put leg of that, then I pay fewer commission. You can see just 64 cents. But I let the rest of the remaining 4 straddles play out because even though SPY went above the green EMA, it did not go above the blue EMA, which means it was still bearish, and as you can see, it went back below the green one and continued to go down. So I basically waited until the end of the day to close my position because I didn't want to hold any shares either long or short going into the next day. So at 12:57, just a few minutes before the market closed, I closed out my other 4 put positions, basically just sold them. And also during yesterday, Thursday, I put in a 457, 458 strangle. So here's a screenshot intraday of what happened yesterday. These are now closed, so you won't see them anymore in my portfolio, but I took a screenshot of this, and you can see at one point, this was around maybe half an hour before the market closed, my 458 straddles were worth $2,492. This was after I closed out one of my puts, so instead of 5 straddles, I have 4. And you can see the realized profit from closing out that one straddle is 425. Plus, I had at one point 2015 in unrealized gains from this straddle. That was like the peak profit time of the day. And if I had closed out all of my straddles at that time, it would have been a nice $2,400 in profit there. But of course, you have to practice risk management along the way. I also open a strangle here, which is sort of like a straddle, except I'm using 2 different strikes instead of 1. So I basically bought the 457 put and the 458 call, which made up this strangle. And that was early on in the day as well. And it's sort of the same idea. I start by paying $191, but as you can see, at least at this time during the day, each of these strangles were worth 549, so I can sell it for a pretty good profit right there. What happened was at the end of the day, I decided to close one of my positions because unlike the straddle, this strangle I have expiring today, which is Friday the 28th. So instead of a 0 DTE strategy, this is like a 1 day to expiration because I put on this strangle on the 27th and it expires on the 28th. So at the end of the day, the 457, 458 strangle on Thursday, you can see here 12:59, right before market closed, I sold one of my positions and made $458. So even though I still had one strangle left, I already made back all of the money that I paid to open up those 2 strangle positions. And I just left it until today. The reason why I wanted to close it and not wait until today is just to hedge my bets, because if the market were to go up on Friday, which now we know that it did, then the value of my strangle here would go down. So that's why I closed one position to lock in my gains. And the reason I didn't sell both of them yesterday was because you never know, like the market could go down, right? The nice thing about strangles and straddles is that you can make a lot of money if the market continues going in that one direction, right? If you remember this profit loss graph, let's say the market goes down. Well, the more the market goes down, the more money I'm going to make as that arrow goes up and up. This profit here is going to get higher and higher. Same thing if it goes the other way, which is not the case this time, but that could potentially be really good if the market is really bullish. Okay, so that was Thursday. If you add up all the transactions minus commissions, you get 2103. That is the biggest one-day profit I have ever made, so I'm really grateful for that. Now for today, Friday, let's just take a look at my live trades for today's session. I put in quite a lot of trades today, as you can see here, but about half of these are closing positions that I opened. So I'm going to go over these maybe in chronological order, just like before. And as you can see here, this is for Friday's trade. So all of this is Friday from this line to this line. And really, there's only a few trades. And then some of them I've closed out along the way. So starting here at 8 a.m. or 11 a.m. Pacific, I sold a couple of bull puts at 456, 455. So that would be this bar over here, 1055. I was bullish over here because just like before, there was a gap up. And if there's a gap up, then like I mentioned earlier, it'll either be a gap and go, which means, it's gapped up and it's going to continue going higher, or it's going to be a gap and fill, in which case it'll have to come down and fill this entire gap that it left from the end of Thursday. Now, out of those situations, I think the most likely scenario is that it's going to be a gap and go. And that's because the market gapped higher and it's continuing to go higher, right? So at this like 1055 mark, the SPY is above the green line, above the 9 EMA, and both the 9 and 21 EMAs are going upwards. So that's pretty bullish. And if I were to bring up the MACD and the RSI at this point, you can see the MACD is very positive. These bars are green. We haven't seen any red bars yet, like later in the afternoon. And then the RSI, relative strength index, is above the 50 mark, and it looks like it's going flat or slightly higher. So pretty bullish right here. I decided to put in this 456 short call with the 455 protection to make the bull put spread. And that's 2 positions. And later in the day, I decided to sell one of the positions and pay $24. And then I let the remaining one just expire out of the money, which it did. So I collected $60 by opening the position, and then I closed one for $24. And the reason I closed one of them at 10.11, so that would be around 1:11, which is around here, is because the market is starting to go down. You can see the green line has crossed below the blue line. MACD has gone negative, right? Because this line right here, this horizontal line, is the 0 line on the MACD, and the RSI is below the 50 line, and it looks like it was continuing to go down. So I got a little bit nervous here. I decided to sell out one of my positions and scale out. Now, it's a good thing I didn't sell both because, as you can see, the market did, after just like 10 or 15 more minutes, reversed again, and eventually this purple line here is let's make this 456. So eventually it went back above 456 and expired at 456.92 is the closing price for the SPY, which means the 455 and 456, both of these strikes are now worthless. As we can see here, that's this one here. My average price was about 28, and I have just one of these positions remaining, expiring today. Okay, and then I put in another short strangle over here. So this one I put in at 10:15. It was a 454 and 459 short strangle. Yeah, so that would be like right in the afternoon around here when the market turned over. My original thought was that it was going to be a gap and go, which meant that we were going to go higher for the day, maybe something like this. Or if I were to draw this into a channel, maybe something like this. But when we broke through that channel, and especially when the green line went below the blue line, I thought, maybe it's going to come down and retest the bottom of the day, but it's probably not going to be a gap and fill still. So I was still expecting the market to be up and not come back all the way down to fill this gap, because at that point, at least the momentum was still going up. And if I turn on the 50 EMA, for the most part, the stock has been above the 50 the whole time, which is this red line over here. But because the price has broken out of this channel, which means it's no longer going up anymore, it was a sign to me that we're not going to see a lot of volatility for the rest of the day. Because if the market was really strong, then we would continue going up in this channel and go higher. If the market was weak, then this never should have happened in the first place. Instead of this gapping up and go, it should have been a gap and fill, and the market should have been going down instead of going up earlier in the day. So this level of indecision, like it's not really strong one way or the other, kind of tells me the rest of the day is probably going to be low volatility. And that strangle that I had yesterday, the one that I left until today, I might as well just close that, because it's not likely that the stock is going to move abruptly in one direction or another. And for you to make money on a strangle, you want the stock to move. It doesn't matter up or down, but you want volatility. And it didn't look like there was going to be a lot of volatility for the rest of the day. So at 2:20, 2:25, this is when I closed my short strangle from yesterday. It's basically this one, the 458 call. I closed that, sold it, and I sold the 457 put as well, and I made $50 by selling those. So overall, this was a loss because if you remember from yesterday's short strangle when I paid 191 for them, but this is why I closed one of my positions yesterday to lock in those gains just in case. Compared to yesterday, today was basically just consolidation with a fake breakout up here, mirrored by a fake breakdown over here. And all the market really wanted to do today was just consolidate and just basically chop. So close the strangle there. And then sort of the last thing was over here, 457 short straddle. I decided to go for another straddle, but in this case, I'm going short instead of long. So yesterday, my 458 straddle, I was long. In other words, I wanted the market to move. But today, because I thought the market wasn't going to move too much, I did a short straddle. So it's the same sort of thing, except instead of buying the 457 call and buying the 457 put, I just sold the 457 put and call. And by doing that, I gain a premium. And the idea is by the end of the day, the market doesn't move much. So 457 is right here. So when I put on that trade, the short straddle, this would be over here, a 457 put, sold, 457 call, sold that. That was at about 12.25. So at 3.25 right here is when I put on that trade. Now I would make the most money if the market closed right at 457, which it almost did today. I mean, it closed at 456.92, which is just 8 cents away from 457. So I could have almost made maximum profit over here. But as the market started to head down this way, I got out of my short put position. I closed it and I kept the short call position open. And basically all of that just made out to break even because I made $56 by selling the call and the put. But when I bought back the put, I also paid $56. So the actual trade broke even, but I did lose some money, of course, from trading fees. And that's basically most of the trades for SPY I have today. The only other thing was this bear call that I put in after the market closed. So this was at 114 or 414 Pacific. And this is just a bear call expiring next Friday. So today is the 28th. Next Friday is August the 4th. Going into next week, I expect the market to be kind of flat. So I don't think the market will go to 466 by next week. And then also when the market closed, I put on this call ratio spread. It's the same thing as the Activision Blizzard ratio spread that I put on a few months ago. I just had a video out about that. And I basically just bought a 462 call. And in order to make a credit, I sold 2 of the 463 calls. So this is what the performance graph looks like. I pretty much make money as long as the market stays below 464.3. That's my break even. And I can make a lot of money. That's where this bump is at 463. So I like using this strategy because it gives me the chance to make a lot of money if the market continues going up like it has been, but it also protects my downside because I don't lose any money if the market decides to go down. If I go to the hourly chart and just zoom out, so this blue bull channel that I have put in basically follows the price of the SPY for the last month or so. And it's now touched the top of this channel 2 times, and it was close to touching it yesterday here, but it failed to do so before dropping down. But it did bounce off of the middle of this channel here. And for next week, by the end of the week over here, Friday, August 4th, if this channel continues to play out, then it's most likely that the highest that the SPY can go to is up here at 464. And that's why I put in the ratio spread with 464 as the break even. Most likely, SPY is going to end next week somewhere over here in this channel because it's been in this channel for so long that it's just most likely going to continue following this channel. So in terms of what I have left for next week, really not much. This 457 call option is expiring today and it's worth 0. If I take a look at combos, which are option strategies, most of my SPY options like these ones are expiring out of the money. So you can see their market price is now worth 0. I have this one, which is the bear call, carried over to next week. And I have the ratio spread, which I just talked about. So I'm going to do a tally of my SPY transactions today to get a total count. I have different credits and debits in here. Starting from the top, that's $36 plus this $12 transaction. So that's a total of $147 in net credit. This would be for Friday. And then the total commission I paid for these SPY trades is $21.09. Okay, so my total profit minus fees is $126 for today. So in total for week 30, that's going to be $27.64 from Monday to Friday, with Thursday's massive profit taking up most of this number. And that should bring my total premiums to very close to 10,000 so far for this year. And that's a pretty big weekly return for a total return of 33% so far. And let's take a look at what the S&P 500 did. Up 1.05%. With the year to date being 19.48. Okay, and this is the updated graph here. I wasn't expecting such a large gain this week, but that is a nice surprise. And it's really just having an understanding of gaps and how they work. Most of the time, it's either going to be a gap and go or a gap and fill. So if there's a gap and the market starts to head in the opposite direction of how the gap happened, then it's most likely going to be a gap and fill. If the market goes in the same direction as the gap, so here's a gap up and it goes higher, then most likely it's not going to be filled and it's going to be a gap and go. So when you think that there's going to be a big move in the market, a straddle strategy is going to be really good at taking advantage of that. And if you think there's going to be less volatility in the market, then a short straddle or a short strangle are strategies you can look to implement. So that's going to be it for this week. Thanks a lot for watching. Good luck with your investments, and I'll talk to you in the next one.